Hi guys, welcome back to class number 12 on CMA and financial management. So we are discussing on decision making tools chapter. So after completing all the illustration problems, we are into the additional problems on marginal costing that is given in your book. So today in our class we are going to cover problem number 21, 22 and 23. So we have 44 problems. I hope we can cover in 3 or 4 more videos all the additional problems. Okay, so maximum problems which are all very unique type, which is not covered in the illustrations, only those things I am covering in this videos. So which is very similar to the illustrations or very similar to the same problem which we have discussed earlier. I'm giving that for homework, and please do work it out. Please watch the videos in a order so that all the formulas of previous videos I will not discuss in detail in the next class. So please watch the videos in order. Okay, so guys, we will go for the first problem of this session. Problem number 21. The manager of a company provides you with the following information. Sales is 4 lakh. Cost is given as variable cost 60% of sales. So this type of information we have already read in one of the question. If variable cost is 60% of sales, what is 40% of sales? It's going to be the contribution. So and that 40% of sales, which is the contribution, is otherwise called as the PV ratio. So guys, you have to absorb all the facts very clearly. Okay, if variable cost is 60% of the sales, the balance 40% of the sales is going to be the contribution. So the 40% is contribution, which means 40% is the PV ratio. So how much percentage of sales is contribution, and that percentage we call it as PV ratio or contribution margin. Okay, so next, fixed cost is given as 80,000. Profit before tax is given as 80,000. Profit before tax is also 80,000. Income tax is given deducted from the profit before tax, and after income tax is deducted, it becomes profit after tax or net profit, which comes to 32,000. The company is thinking of expanding the plant. So the plant is manufacturing something, and the company is thinking of expanding it. The increased fixed cost, if the company expands the new area, we have to pay the rent for it, we have to employ some more additional persons for housekeeping, maybe for material management, maybe for running the production shop, supervisors. So there will be some fixed cost for the new expansion also. So that is approximately 40,000 is the increased fixed cost. Currently the fixed cost is 80,000, and it will go up by another 40,000 if we do this expansion. It is estimated that maximum production in the new plant will be worth 2.4 lakhs. So the maximum production is 2.4 lakhs. The company also wants to earn additional income of 3,200 on investment. Okay, so how much is investment they have not given, but from that investment they want to earn 3,200 rupees during that period. On the basis of the company, give your opinion whether the plant expansion is good or not. So what we have to say, whether the expansion is good or not. So we have all the detail about the marginal costing statement in the current state, which means before expansion. In the before expansion, we know what is the sales. It is 4 lakh that is given. 60% is variable cost, which is 2.4 lakhs. If we reduce, we will get the balance 40%, which is the PV ratio as the contribution. So contribution is 4 lakh minus 2.4 lakh. It is 1.6 lakhs is the contribution. Now we have the fixed cost also 80,000. So contribution, fixed cost, contribution minus fixed cost is the net profit. So 1,60,000 minus 80,000, it is 80,000. It is already given in the question. Okay, but it is in a very little bit difficult to decode. So we have to decode by putting a marginal cost statement. So what is a marginal cost statement? If you arrange all the particulars like this, it becomes a marginal cost statement. Sales less variable cost gives you the contribution, less fixed cost gives you the profit before tax, less tax will give you the net profit or profit after tax. So this is what we call it as marginal cost statement. Okay, so we have reduced the fixed cost and the net profit will be 80,000, and they have given after tax profit is 32,000. So which means 80,000 is profit before tax, 32,000 is profit after tax. So 80,000 minus 32,000 is the tax portion. So how much is the tax portion? Approximately 48,000. So 48,000 is how much percentage of 80,000? It is 60% of 80,000. So which means the tax rate is 60%. So we have found out the tax rate as 60%. So if you reduce 60% on the 80,000, 48,000 will go out as tax we will pay to the government, and the balance will be the 32,000. That will be the profit after tax, which is already given in the question, but they have not given what is the income tax that is deducted. We have found what is the income tax that is deducted, and also we have found the tax rate. Okay, so this is the reason why we are putting the marginal cost statement for before expansion also. Though they have given all the detail, we are putting it very clearly so that we found what is the variable cost, what is the contribution, what is the tax rate, and what is the tax amount. Okay, and profit after tax. Okay, now what we are going to do, our managers, already we are making a profit, company is proposing some expansion. With that expansion, if we are maintaining this profit or we are going to earn more profit, then it is well and good. But if that expansion will give you additional fixed cost and that will eat away your existing profit, then that is not good. So as a finance department person, what you have to do, you have to think whether the expansion is good for us or not for us. Which is good for us? If the present profitability is increased because of expansion, it is good for us. Let us see whether it is increased or decreased. Okay, so it is said that the maximum production from the new plant is 2.4 lakhs. So we have to assume something, guys. So what they, in the new expansion, they can produce a maximum of 2.4 lakh. We have to assume that all the produced quantity is sold. So I am taking the sales as 2.4 lakhs from the expanded unit. Now 60% variable cost, that is not going to change. The same material, labor that you are going to use, the same thing only you are going to use that in the expanded plant also. The same material will be used, the same labor at the same labor cost will be, we are assuming that the same labors will be put on the production line. And if the existing labor, you take some hours for manufacturing, the same hours the labor will do in the new shop also. These are all assumptions. Okay, so the same 60% of variable cost I am reducing. So 60% of 2.4 lakhs is 1.44 lakhs. I am reducing. The contribution from the expanded plant will be 96,000 rupees. Now they have given, because of this expansion, a new fixed cost for the expanded plant is 40,000 rupees. So I am reducing the 40,000 from here, and I will be left out with the profit before tax. Okay, profit before tax will be 96,000 minus 40,000 is 56,000. Now 60% tax rate, that is not going to change. So 56,000, 60% of 56,000 will be 33,600. I am reducing the tax and I am getting a positive profit of 22,400. So which means my overall profit after expansion will be 32,000 plus 22,400. So guys, you can put one more column, before expansion plus after expansion, and you can say that the profit of the company after expansion has gone up by 22,400. Hence, from the finance department point of view, we can accept the proposal for going forward for the expansion. Okay, and we have to give important instruction to marketing. Because of your input, that 2.4 lakhs unit can be produced and sold. With that input only, we are saying that this is possible. Okay, so yes guys, so we will go to the next problem. A manufacturer with overall interchangeable among the products, okay, with overall capacity of 1 lakh machine hours. So a manufacturer is having 1 lakh machine hours as his capacity, has been so far producing a standard mix of 15,000 units of A, 10,000 units of B and C each. So 10,000 B, 10,000 C. This is his standard mix. On experience, the total expenditure exclusive of his fixed charges is found to be exclusive of his, what does that say? Without including the fixed charges, his overall expenditure is 2.09 lakh, and the cost ratio among the product approximately 1 is to 1.5 is to 1.75. So they have given the cost ratio between the product. So this is the variable cost ratio, because they have said the expenditures excluding the fixed charge. So which means they are talking about the variable cost. So variable cost, they found it is 2.09 lakh is the total variable cost. Okay, and on the experience, okay, and the cost ratio among the product is 1 is to 1.5 is to 1.75 respectively per unit. the fixed charger comes to 2 rupees per unit. So fixed charges is 2 rupees per unit. And also, okay, because they have discussed only about the variable cost earlier, now they are saying 2 rupee per unit is the fixed cost. When the unit selling prices are 6.25, so selling prices is given for A, for B, for C. So this person, this manufacturer guys, so he has a capacity of 1 lakh machine hours, and so far he has been producing 15,000 numbers of A, 10,000 numbers of B, and 10,000 numbers of C. And his expenditure, variable cost, how much variable cost, total variable cost, how much also he has given, and variable cost of A is to B is to C also he has given, and fixed charges also per unit he has given, selling price per unit of A, B and C also he has given. It is very easy guys. Mix 1, mix 2 and mix 3. So he is proposing 3 mixes. So currently he is producing 15,000 A, 10,000 B and 10,000 C, and he is proposing 3 mixes, mix 1, mix 2 and mix 3 as management accountant. So guys, the question is given to us. We are the management accountant. As management accountant, what mix will you recommend? Okay, so we have to compare the present mix and also the 3 mixes that they have given. In which mix we are going to make the maximum profit, we are going to select it. So very clear, decision making is very clear. But for that decision making, we need some data to be calculated. Currently, selling price per unit is given, minus variable cost will give you the contribution per unit. Do we know the variable cost? We don't know the variable cost. Yes, we will find the variable cost. First, it is given 1 is to 1.5 is to 1.75, which means I am assuming the variable cost as X. Then it will become 1X as A, 1.5X as B, 1.75X as C. This is the variable cost. Now we know what is the present manufacturing quantity, production quantity: 15,000 A, 10,000 B and 10,000 C. So 15,000, 10,000, 10,000. So per unit variable cost 1x, 1.5x and 1.75x. I hope you are clear guys. So multiply the per unit variable cost multiplied by the production quantity will give you the total variable cost. So 15,000 into 1x will become 15,000x, 10,000 into 1.5x will become 15,000x, and 10,000 into 1.75x will become 17,500x. What will be the total variable cost? 47,500x. We already know the total variable cost is given as 2.09 lakhs. So which means 47,500x is equal to 2.09 lakhs, which means x is equal to 4.4. If x is equal to 4.4, we can easily find the variable cost per unit of A, B and C. A is 1 into x, 1 into 4.4, A will become 4.4 is the variable cost, B will become 1.5 into 4.4, C will become 1.75 into 4.4. Now we have the selling price of A, B and C, and also we have the variable cost per unit of A, B and C. So which means we can find the contribution and we can reduce the fixed cost, and we can also find the net profit for all the cases. Now let's go to the current mix. So the current mix is A is produced 15,000, B is 10,000 and C is 10,000. We know the variable cost per unit. We know the price per unit: 6.25, 7.5 and 10.5. It is already given. Selling prices 6.25, 7.5 and 10.5. So selling price minus variable cost, find the contribution for A, contribution per unit for A, B and C. Now contribution per unit multiplied by the production quantity, you can find the total contribution comes to 64,750. Now what is the fixed cost? It is given as fixed charges is 2 rupee per unit. So how much units you are making? 15,000 of A, 10,000 of B and 10,000 of C, putting together 35,000 units. Into 2, 35,000 into 2 is 70,000 is a fixed cost. 64,750 minus 70,000, your net profit is negative, which means you are making a loss of 5,250 in the current mix. Now you have got 3 proposals from the sales department or a production department or technical department. What are the 3 mixes? Let's take the mix number 1. Mix number 1 says 18,000, 12,000 and 7,000. Variable cost is not going to change. Selling price is also not going to change. Selling price minus variable cost gives the contribution per unit, and multiplied by the mix quantity or the production quantity, you can find the total contribution is 63,700. We already know the fixed cost is 70,000. So 70,000 fixed cost. So guys, here you should not go 2 rupee per unit fixed charge is given. So total quantity is 12,000 plus 18,000, 30,000 plus 7,000, 37,000 into 2 rupees. That will go wrong, guys. Fixed charge will not vary with the number of unit. So calculate the fixed cost for the present production level, okay, which is 70,000, and apply the 70,000 for all the cases. So many students make mistake in the fixed cost, and because of which everything will go wrong, guys. Okay, see, your decision itself will go wrong. Okay, you will select a decision which is really not profitable, and you will say that that is most profitable if you end up doing a wrong calculation of fixed cost. So always, if production quantity is given at the current level, apply the per unit fixed cost on the production quantity, fix the overall number as fixed cost, and apply that for all the cases. If they have given a full fixed cost, then there is no issue. When per unit fixed cost is given, the confusion comes up, but I know my students will not be confused with the fixed cost. Watch all the videos in order. The main problem where we can go wrong is fixed cost. Okay, so the same 70,000 fixed cost will be the 70,000 fixed cost for all the cases. So 63,700 is the contribution minus fixed cost. In mix 1 also I am making a loss of 6,300 rupees. Now let's take the mix number 2. I hope you can do the calculation now. Variable cost will not change, price will not change, contribution also will not change, but contribution multiplied by the mix quantity. The mix quantity is 15,000, 6,000 and 13,000. And now we are making a total contribution of 69,550, and fixed cost is 70,000. So we are ending up making a very minute loss of 450 rupees. Still loss is a loss. Let's go to make the mix number 3. So mix number 3 also apply the same formulas and same product. Find the total contribution. We are ending up making 70,300 as a total contribution. 70,000 is a fixed cost, which means we are making money here. We are making profit of 300 rupees, which we are making our profit is in the positive territory. We have not made any loss. So if you compare all the current scenario and all these three mixes, mix 3, okay, is the place where we are making the more profit or more money, okay, or we are not ending up making a loss. So mix 3 is the best. That is what, as a management accountant, I recommend mix 3 for the technical team or the corporate. Let's go to the next problem. A company. So this problem we have already seen in previous video, but we have already seen all the possible questions in this problem, but I want to discuss this because there is high probability this question you may get in 4 marks. Okay, never miss this kind of opportunity. These problems are very simple to answer, provided you know all the fundamentals of marginal costing. A company has an annual fixed cost of 1,40,000 rupees. Annual fixed cost is given 1,40,000 rupees. In 2015, the sales is 6 lakhs compared with 4,50,000 in 2015. Okay, so which means sales of 2 years is given. Next, the profit of 2015 is 42,000, higher 42,000 higher than 2014. From 2014, 2015 profit is higher by 42,000. So guys, remember, we studied two formula for PV ratio. One of the formula is contribution divided by sales is the PV ratio, or otherwise called as contribution margin. There were one of the previous video, we have also seen one more formula for PV ratio, change in sales divided by, the change in profit divided by change in sales. So this problem is one such kind, One second. So guys, this problem is one such problem where we have given two periods. Okay, change in sales of the period can be found. Okay, in this case, 2014, the sales was 4,50,000, and 2015, the sales was 6 lakhs. So 4.5 lakhs to 6 lakh, 1.5 lakhs delta in sales, and profit. What is the delta? 42,000 delta in profit. So delta in profit divided by delta in sales is also a formula for PV ratio. We discussed this in one of our classes. Okay, so 42,000 divided by 1.5 lakhs, we can find the PV ratio. So PV ratio is there. Also the annual fixed cost of 1.4 lakhs, that is also given in the question. When fixed cost is given, also the PV ratio we have, we can find the break even sales, which is fixed cost divided by PV ratio, guys. Okay, so fixed cost divided. So what is the first question? At what level of sales does the company break even? Of course, when these two details are there, of course the question will ask you about the break even sales, which means so here the PV ratio comes to 28%. So fixed cost divided by PV ratio, which is 1.4 lakhs divided by 28%, will give you the break even sales quantity. What is the next question? Determine the profit or loss on a forecast sales volume of 8 lakh rupees. So 8 lakhs rupees is a sales. We can easily find the contribution because we have the PV ratio. 28% is the PV ratio. So 28% of 8 lakhs will be the contribution. So we can find the contribution, and then we also have a detail of fixed cost. So contribution minus fixed cost is going to be the net profit. So whether the profit or loss, whether if the value is negative, it's going to be loss. You can find it. I'm very sure about it. The last question is very important. If this comes in 4 marks question, okay, the 2 marks will go for the last division itself, and if it comes in 6 marks question, I'm sure 3 to 4 marks will be for the last division only, and that is the reason I choose to solve this problem. Okay, if there is a reduction in selling price by 10% in 2016, so we discussed about 2014, 2015, and with this comparative year, we found the PV ratio, we found the contribution, we found the break-even sales, all those stuff. Now 2016, there is a reduction in the selling prices expected, and the company desires to earn the same amount of profit as in 2015. Okay, so what is the profit that is earned in 2015? We have to calculate that first. Okay, so in 2015 the sales is 6 lakhs. In 6 lakhs, PV ratio is 28%. So 28% of 6 lakhs is the contribution, minus 1.4 lakhs is the fixed cost. So 28% of 6 lakhs is the contribution, minus fixed cost. So total 28,000 rupees is the net profit that we have earned in 2015. Now what is the question says? Company desires to earn the same profit in 2016 also. So we want a profit of 28,000 rupees. So the one portion is answered. The next is how much is the profit that we have calculated. Next, it also says selling price goes down by 10% in 2016, 10% from 2015 level. In 2015, selling price is not given, but sales is given, which is 6 lakhs rupees. So 6 lakh rupee is the 100%. So 10% it has gone down, which is 90% of 6 lakhs. So in 2016, the sales is going to be 5.4 lakhs, which is 10% gone down. So 5.4 lakhs is the sales. Now they have not given any detail about variable cost, which means variable cost is same. So variable cost is same. Our sales has gone down, which means contribution is to go down. Am I right, guys? 10% sales has gone down, variable cost is same, so contribution will go down, so the PV ratio will not be the same. PV ratio will change. Okay, if contribution is to the ratio of contribution to sales is going to change, which means PV ratio is going to change. That is where is the crux in this problem. Okay, so we should not apply the same PV ratio for the question number 3 and end up doing wrongly. That's why the last question has the highest weightage among these 3 questions. Okay, so now variable cost is same and the sales has gone down by 10%. So 10% the sales becomes 5.4 lakhs, which means 6 lakhs sales has become 5.4 lakhs. So 60,000 the sales has gone down. Variable cost is exactly same. Variable cost is same as 2015 itself. So which means the same 60,000 rupees, the contribution has to go down. Contribution will go down. So 6 lakhs PV ratio was 28% earlier. So 6 lakhs into 28 percentage, and now the contribution has gone down by 60,000 because sales has gone down by 60,000. It will not happen usually, but here due to competitive pressure, the company is reducing the selling price by 10 percentage, and it is not touching the fixed cost at all. Okay, so fixed cost is remaining the same. So the variable cost is going to remain the same. Variable cost of 6 lakh sales is going to be the variable cost for 2016 also, but the selling price you have reduced, because of which 6 lakh sales has become 5.4 lakh sales, but 60 percentage, which is the variable cost which we discussed earlier, the same variable cost of 2015 is going to be the variable cost of 2016. What is the variable cost of 2015? It is 28 percentage of 6 lakhs. Now the contribution, so variable cost is going to be the same, sales is going to reduce by 60,000, which means contribution will reduce by 60,000. So what is the contribution of 2015? It is 28 percentage of 6 lakhs minus 60,000 rupees will be the contribution for 2016. So it's going to be 1.08 lakhs will be the contribution for 2016 year. For 2016 we have already calculated the sales. Now we have calculated the contribution. Contribution divided by sales will be the PV ratio for 2016. So 2015, 2014 and 2015, the PV ratio of 28 percentage. Now the PV ratio, what is the PV ratio? 1.08 lakhs is the contribution divided by sales of 5.4 lakhs. It comes to 20 percentage. So which means PV ratio has gone down. So do you understand the logic, guys? The variable cost is same, selling price has gone down, so which means our contribution will go down. When our contribution goes down, PV ratio will come down. That's why 28 percentage has gone down to 20 percentage. So we have to know the formulas, we have to know the facts behind it, which is driving force for the formulas. Okay, so now the PV ratio is 20 percentage. I hope you got it. Okay, that's 6 lakhs of sales in 2015 had a variable cost. The same amount of sales you are making in quantity wise, you are making the same amount of sales in 2016 also. So the variable cost is same, but sales has reduced by 10 percentage. 6 lakh rupee of sales has become 5.4 lakh of sales. So 60,000 drop in sales, and the same variable cost is going to cause 60,000 drop in the contribution. So contribution has gone down by 60,000 rupees, and the new contribution is 1.08 lakh. Contribution we have 5.4 lakhs of sales we have. Contribution divided by sales is going to be the PV ratio. Now we have the PV ratio. So we have the PV ratio, which is 20 percentage. Now what is the required profit that we have to earn? We have to earn, okay, usually break even sales is fixed cost divided by PV ratio, but here fixed cost plus we need to earn some profit. The same profit of 2015 we have to earn in 2016 also. We have already calculated 28,000 is the profit company is interested to earn in 2016. So fixed cost how much? 1.4 lakhs. And what is the profit desired to be earned, which is 28,000. 1.4 lakh plus 28,000 comes to 1.68 lakhs, and PV ratio of 20 percentage. So 1.68 lakh divided by 20 percentage is the desired sales to achieve a profit of 28,000 rupees in the year of 2016. So as a management accountant, you can give your final conclusive remarks. So guys, meet you in the next class. Thank you.